Thank you so much for tuning in to Exit Ready. Hope you enjoyed today's episode. We're going to unpack ways for you to make your company more valuable so that when you get ready to exit, you can get the most money possible. Now to the show. Well, the legend SBA Ray, I think it's how I first heard of you was SBA Ray years ago. So it's great to finally talk to you. How's it going, man?
It's going well. I don't know about legend, but I appreciate it.
In this world, you're a legend, okay? So there you go. You can go home, tell your family, get called a legend today. It doesn't matter about who or what the context was. You can wear that title proudly.
I prefer the term micro influencer.
Micro influencer, legendary micro influencer. There we go. There we go. Okay,
Exactly.
Ray, give everyone a quick background. Obviously, with the name SBA, it's kind of somewhat clear what you do, but go ahead and unpack that for us real quick.
100%. That is all I do. It's all I've ever done, really, is I'm very passionate about SBA lending. I fell into the SBA industry in 2012, 2011, as I was graduating college. Haven't looked back. What are we, 15 years later? And I just came up through the BDO sort of channel. That's the business development officer. That's typically who you're working with at one of these SBA banks when you're, requesting a loan to buy a business or whatever. And, I kind of gravitated more into management as I got later into my career. And most recently, I'm managing director at True Liant Federal Credit Union. We're a $5 billion credit union out of North Carolina, but we operate nationally. And over the last, year and a half or so, we've actually become the number one credit union in SBA 7A lender. Or in 7A lending. So we're very big. We're very active, particularly in the acquisition space. So that's what I've been up to.
Okay, now I'm not in North Carolina. I'm in Texas, but if I had to guess, and I don't know. I didn't do this, so I could be wrong here, but I'm guessing that there's not a lot of retail walk-in spaces for your bank. It's probably mainly like a lot of these other SBA banks, or is that not the case with you guys?
Well, it's interesting. I've been following your journey, and you've been interviewing a lot of folks in the SBA space, and you're 100% right. These big banks that you would know, these name brand, banks, they are like, for example, like Truist is one of the biggest banks around here, and we just do so much more SBA lending than someone like them, including them. And we have, I don't know how many branches we have, but we have branches in very limited markets, kind of in sort of South Carolina, North Carolina, and western part of Virginia. But I'm in Florida, and we have about a 30-person SBA team, and I don't think we have a single person in where we're headquartered. We're all operating remotely across like 20 different states, as east as Idaho, as north as Syracuse, Texas. I'm in South Florida, so yeah, that's kind of how SBA lenders do it. Is how it's been done for many years, actually.
It's weird that you said as east as Idaho. That's pretty that's pretty
Oh,
far
I'm sorry,
west.
West. We'll
No,
fix that
no,
in post.
no. It's great. It's great.
Just bleep
Where's
that
east?
over my words. It'll just
I,
be
li-
you saying
I actually
West.
like it because it's like, wait, as east as Idaho. Hold on, wait, that's way west. That's actually
That's
a
my
good way to
bad.
put it. That's a good way to put it. I love it. No, I
Hey,
love
I,
it.
I want to ask you a question though. I know
Yeah,
I know you're
yeah.
supposed to ask the questions, but
You
you've
ask
been
all you want.
interviewing some SBA folks, and you've been at
Hmm.
this journey. You're uploading like a video a day. By the way, if you haven't subscribed, you got to subscribe to this guy. This is you're crushing it on the content.
Thank you.
What have you learned, or maybe something that's surprising that you've learned about SBA lending through all these conversations with all these SBA experts?
Mm. Oh, that's a good question. I think. Well, the rules has changed today, so we might talk about that in a minute. So I'm going to say
That's
this: if
one.
you go to know, if you go to know the rules change, Ryan, that's off. Um, I think that what I've really gathered is a theory that I thought to be true, but everyone's verified, and that people like yourself would welcome talking to owners to see what they would lend on their business. And I thought that to be true, but hearing the people that I've interviewed say, we would work with owners. Most of the time, it's about they're soliciting the buyers on social media, whatnot, and knowing that the owners actually have this option to go for them. And I think not from the standpoint of the owner know the valuation. But I'm curious your take on the, because I haven't asked this about the terms of the deal, if it's actually beneficial for the owner, not in the sense of what they're going to get cash at closing, but to help make it easier for the buyer if the owner reaches out to the bank directly and says, hey, use Ray because of some of the stuff that happens if they go through a third party. And so I thought that to be true. It's been verified, but I've been afraid that some people might go, no, I only want buyers because of the commission they might receive and stuff like that. So what's your take on that? That's kind of been a theory I thought, and it seems to be validated. So
Well, I would tell you the SBA lenders are by and large um, very passionate about what they do. People become SBA lenders, they never do anything else for the most part. Like they just retire. In fact, they don't retire. They just do this until they die. They love it. And um, when we get calls, and I got a call the other day from a former client who I helped him buy a building, and he had two retail locations in two different markets, and he's looking to sell one. So he reached out and he said, "Hey Ray, look, I'm thinking about selling my business, and I want to get this thing. I want to package this deal up perfectly for the buyer. I want to, smooth out the wrinkles up front. I just want this to go really smooth, and I want the buyer to use you to finance it." And he's like, "What do you think this is worth?" And we're going through the numbers, and I think that's a great approach, honestly, because he's identifying two potential buyers already. He knows what the pitfalls are going to be, and there's less people in the middle that are trying to bend the communication into certain ways for different types of motives. So in other words, he's getting the communication clearly from the lender, and the lender has the money that's going to show up at closing. So it's like, how do we get this money to fund at closing? Well, I'm going to just tell you directly, and some of it you may like, some of it you may not like, but at least now it's fully unfiltered, and then we kind of start from there. And yeah, I think that's a great approach, and I think most SBA lenders would welcome that.
yeah, because my whole thesis is I talked to a bunch of, how I got into M&A was I helped. I had a buddy that was in M&A, and I referred someone to him years ago. And then I was working on some really big international M&A deals. And then this thing called COVID, I don't know if you heard about it, it happened. It shut down all of that. And so that ended all of that kind of work. And then when I got back into kind of doing M&A, I talked to probably 350 owners, 370, I don't know how to count, but it's over 350. And about selling their business. I was doing a lot of work for some with buyers, but some with still sell-side brokers and stuff like that. And the stories were pretty much the same, just different buckets, right? But a lot of it was the same. They overvalued their business, owner dependency, customer concentration, all the stuff that you probably see over and over again on deals. And it kind of dawned on me that right now there's a lot of education for the buyers, and I think I have some reasons on why that might be, but a lot of education is for the buyers. And it's like, well, the owners are leaving hundreds of thousands or millions of dollars on the table by not simply just doing some things a little bit early on that would just make it easier for them. And one of the things is, since most deals are in the SBA size range anyways, one of the things is just talk to the bank. And that's one thing I learned was talking to owners. If they said, well, I think my company's worth $3 million, and the bank says, yeah, it's worth 3.1 or 2.9 or whatever we can lend on it, the owner goes, okay, cool. They understand that banks will give money. But if you say, I want to give you $4 million, or if they say, I want to give you whatever it is, if it's kind of speculation, they don't trust that. But when they go to the bank and the bank says, oh yeah, $3 million, whatever it is, they might not like that, but they kind of know that's the world that they've lived in their whole career, that banks will lend money. And so to me, it's like, well, why not just talk to the bank sooner to find out what they will do, and then ask the question, can you improve that, and how long does that take? Because certain levers you pull can take longer to fix, some are kind of faster, but like customer concentration might take 18 to 36 months to smooth that out. Whereas, owner dependency might get fixed in 6 to 12 months. So anyway, so I'll quit rambling, but that's kind of what I saw. And then having these conversations, like, okay, well, as many of the banks, I hope, talk to owners, because I think that's really, for a lot of them, step one, but 1A maybe.
Well, the interesting part is, and I fully agree with what you're saying, you don't see it as much as you'd think.
Yeah.
but every owner has a bank.
Yeah.
So, that banker, even if they're not a hugely active SBA lender, they probably have someone in the bank that is their M&A sort of
Yeah.
finance person. And I mean, at a minimum, you could just, talk to your banker. I mean, wouldn't I,
Yeah.
I would think that that would be that used to be like a standard approach. You'd actually go down to
Mm-hmm.
the bank and
Mm-hmm.
have these conversations. Hey, look, I'm
Mm-hmm.
been here banking for 20 years. I'm thinking about selling. What do you think?
Right.
And you'd
What do
have
you
that
think?
consultative approach. And our industry, banking has gotten super commoditized. So I
Mm-hmm.
don't think that those relationships are there as much today.
Yeah. And I think that some owners I've talked to, they've gone to their bank and they've had that conversation, and then the bank's not really well versed in SBA stuff, and so they might get told bad advice, like, "Oh, your business isn't
Sure.
SBA eligible," or they might be SBA eligible, but the bank doesn't tell them that our bank doesn't really do M&A deals like this. It has nothing to do with the SBA. It's that our bank, and so there's some confusion on what happens. It seems with the owners and with buyers too. They'll call an SBA lender and say, "I want to buy a company," and call a bank rather. And the bank says, "No, you don't qualify, or the SBA doesn't qualify." And it's not SBA related at all. It's just that bank has a buy box. And
100%.
so,
Well,
yeah.
and SBA specifically, you're right. And by the way, 1 out of every 10 deals I hear from the business broker or the buyer that the seller just does not want to have anything to do with SBA. The buyer,
Mm,
we don't want to have an SBA buyer, blah, blah, blah. It's like, where is that coming from, right?
right.
It's chances are they at some point in their business,
Mm-hmm.
career sat down with their banker and were told some really bad things about SBA,
Mm-hmm.
mostly because that banker didn't have a
Yeah.
good solid SBA program and was trying to sort of diminish it and focus here on their conventional products, which are easier for them to do and administer. So, there's a lot of that, but you can get a business broker that doesn't know what they're talking about. You can get a really great business broker. You can get an SBA. You can get a banker that doesn't know what they're talking about. You can get a really great SBA person. I think the biggest thing I always give for advice when they're vetting anyone, specifically for SBA lenders, is to actually ask them some really pointed questions about their experience, their track record, their knowledge, and vet them and interview them. Because there's the top 1% of SBA lenders make 40% of the loans. That's 14 lenders making 40% of the loans. It's crazy.
Well, and what I tell buyers, I don't work with buyers right now, but in the past I have, and I've told buyers, even if you say you got cash or family, still take it to the SBA because the owner will believe that valuation more than he will yours. So even if you think you have cash and you can do it, the owner is going to be more comfortable with this, and you might go SBA eventually, anyways. And so it's just something that I think owners, when they hear the bank say, "Yeah, this is what we can do," they just feel more comfortable with it. Now, it doesn't mean that they're going to like that number, but it does take out some of that stuff that I've heard from owners like, "Well, I'm doing X revenue, but I could do Y revenue, and so it's really worth Z." It's like, well, sure you could,
Not
but
quite,
but
not
but
quite.
you're not. You're not, and so it's like,
Yeah.
well, the bank's saying this is what the note can afford. It's like, oh, the owner understands that, so it helps them ground them in reality.
But by the way, talk to five of us.
Yeah, yeah, yeah.
You know, let's come now. If the numbers are all over the place, and they may vary. I mean, look, we don't do valuations. We're
Mm,
not. I'll shoot from the hip, and I'll tell you I'm shooting from the hip on a valuation because I have closed hundreds of acquisitions. But mostly, what the bank should be telling you and will tell you is how much debt we think the business can support. And the reason that's going to range is because there's only two numbers, right? It's the cash flow and it's the debt. And those are the two variables. And so the cash flow might be different because bank A is using all of your ad backs, bank B is using none of your ad backs, and bank C is using some of your ad backs. And then on the debt side, you can have it structured different ways with different seller notes, with different terms, with different SBA interest rates, and that will change as well. And then what's the number they're solving for? It's actually essentially the output. It's the debt service coverage ratio. And some banks will do a deal with pretty skinny debt service coverage, let's say a 1.15, that would be the skinniest. Essentially, it means for every dollar of a debt, there's $1.15 of cash flow to support it. Skinny, almost 1 to 1, right? Just a little over. And then there's some banks that will go 150, 150. So for every dollar of debt, there's $1.50 of cash flow to support it. And I'm kind of somewhere in the middle personally at Truliant, like 125, 135 on most of our deals kind of. So because of all those different nuances, you will probably get some different answers from bank to bank.
And so you mentioned that some owners probably have been given bad advice. Stay away from the SBA because they hear it's scary. I know that the first time I ever heard of the SBA was in 2000 or 2019. And anyways, this guy that was working there, and he's like, "Oh, you don't want to deal with the SBA." Like he worked for the SBA. He's like, "It's a long process. It's hard." And I was like, "Okay, cool, whatever. Went on my merry way." Maybe a lot's changed since 2019. And he was an older gentleman, so maybe he just had a bunch of background. I don't know, but he was like, "You don't want this." I was like, "Okay, cool. Don't want that." Why do you think that most owners have been told to stay away from SBA?
I think it's partially what I said before, which is, let's say a big bank, you know, pick your favorite one. They have an army of commercial lenders out in the market. They do C&I loans, lines of credit, 10 different products, treasury. They got to do all this different stuff. SBA is extremely nuanced. It's niche. It requires specific expertise. So at all banks, there's dedicated SBA staff. At all these big banks, there's dedicated SBA staff. So I got a buddy, he works at one of the biggest banks in the world. He covers the entire state of Florida for this big bank. And he's great. But like the conventional lenders don't want to send deals to him because they're so tight that he says no to 95% of the stuff. So instead of like, and they don't really know what they're looking for specifically, but they know kind of it's an SBA deal, right? So let's send it to this guy. And then, 2 weeks later, they're like, we can't do it. Okay, so you get a few of those and you just start saying, man, SBA is, let's just avoid it. It's just like, it doesn't really work. Now, that's one side of the spectrum. Then on the other side of the spectrum, which you alluded to earlier, is these banks some of these banks are created to do SBA. You have sort of like, it's like a founder-led thing where it's like, I'm going to start a bank. SBA is going to be part of my business plan. I'm going to do it right. I'm going to set it up correctly. I'm going to bring in the expertise and the proven processes, technology, all the experts. Like we did at Truliant. I came in here with 10 people. So they hired 11 of us in kind of one foul swoop. And we literally went from doing $30 million, ish a year to $200 million a year. That's like 5x, basically. And that's because, we allocated dedicated resources toward it. So our borrowers are very happy at the end of the process because we actually know what we're doing. And I just don't think all banks have that level of commitment, and it turns some people off because the experience is sour.
So I'm an owner. I'm listening to this. I'm going, okay, I had someone come in the other day or whatever, and they want to buy my business. I'm not sure what it's worth. I'm going to reach out to Ray. And then from the time that they reach out to Ray, let's assume the buyer's qualified for this hypothetical here, and it's a $3 million deal. Like, how much work is it going to be for the owner? Because that is part of the process for them. And like, it's a lot of work. And so go be honest with them. Like, tell them how much work this really is going to be, just from the SBA standpoint. There's other things involved, of course, but
to do a deal or just to look at it high level?
No, so they call you and say, hey, I got someone's interested. What would you lend to them for, assuming the buyer's qualified in this hypothetical? Like, how much time is it going to be for them with you and the SBA to get the deal across the finish line?
Oh, okay. Yeah, for sure. Because initially what, and this happens, this is what I do every day. So like, if you have something right now, you can literally call me, today or tomorrow, send over some information, and within 24 hours, we're going to be on a call. You're going to be looking at numbers, and you're going to be seeing your business in a whole new light. And so we do that on a daily basis, and that's very easy. We grab a couple tax returns, some 2025 financials, because I'm assuming you're not part of the 10% or 4, whatever. I saw the number the other day, like how many percentage of people filed their taxes so far this year. It's February 3rd as we're recording this. So it's like, so probably your internal financials for last year. And, just with that alone, we can really roll up our sleeves. Now, assuming you have a buyer and we're kind of moving forward on a transaction, I like to lay out a 60-day timeline. That doesn't always happen because there are different extraneous third parties involved. Like you may have a landlord involved, you've got attorneys involved, and we're just along for the ride in some of those conversations. But it's very doable to do something like this from start to finish in 60 days. My fastest time frame is 6.5 weeks, and that's not even that fast. People have done it faster. I like to take my time. I'm a little slow, so it took me 6.5 weeks. Um, so the amount of work, though, I will say that's a great question because that's really what it is. Because it's the amount of work and the time frame you want to deliver the work dictates the timeline. So for the buyer, it's almost like it's almost like a job. It's like maybe a 10-hour week commitment for them. Maybe a little less for the buyer, depending on how prepared they are. But ultimately, there's going to be, on the lender side, 2 tranches of information requests. If you're lucky, it's 2. I try to keep it to 2. Sometimes there's follow-up and, people are always like, you're just killing me. You just keep coming back for more, Ray. I'm like, I'm sorry. I try to break it up into 2, mostly underwriting on the front end, mostly like closing / administrative stuff on the back end. But then you're also getting hit with due diligence, from the buyer who's probably going above and beyond what the lender is asking for, quite honestly. So I'll tell you what, I'm not there with the seller, with the owner. Usually they're with the broker, procuring the document requests. So I don't have a firsthand account of how much work the seller is doing because I'm just requesting the information. But for the buyer specifically, I usually say it's 3 times more work than a home mortgage.
And so, and you made the caveat, I will repeat that. There are other parties in play. And this is why I stress, if you're an owner or a buyer, get a good M&A attorney. If you got a broker, get a good one. Like, don't just go out and be like, oh, my cousin's a divorce attorney, he can handle this. It could just mess the whole deal up. So get good people to help you there. So how long they take is a whole other conversation. But 60 days, you said, okay. Now, if they call you before they go to sell and they say, hey, you mentioned those 2 tranches and that first call you have. If they kind of call you before and say, hey, I'm thinking about going to market, I'm thinking about selling, I want to know what you could lend. Does that lessen the load when they do sell, or is that kind of like still going to be those 2 tranches are post that first phone call?
Yeah, I mean the first tranche is really so the first phone call it'll shave 1 day off. So but the bigger issue is not about shaving 1 day off. It's about, hey, this isn't going to work. You have a problem here. And now instead of finding a buyer and having that problem, you can fix that problem and then find your buyer or something like that, right? So it's really meant to weed out and make sure that this is going to go how you want it to go. And that's worth spending 30 minutes on a call. Now, the information itself, like, we're talking about tax returns and some year-end financials. Beyond that, there's going to be aging AR and AP reports, and there might be a customer list or something like that, and a few other items that we get for the more of a deep dive that we do in the final parts of underwriting. But it's similar to conventional, believe it or not. So SBA lending, the things we request is not that different than what a conventional bank lender is going to request. The big difference with an SBA loan is we do need to follow the SOP to the T. So, a conventional lender may say, hey, you sent me this insurance. There's a couple things on it, but you know what? We'll close and we'll get this fixed after the fact. I know you're good for it. And an SBA lender is going to be more strict and say like, hey, we can't close until you send me the right thing. The SBA doesn't actually look at any of this stuff because most of us are out here as preferred lenders. So we do everything on behalf of the SBA, just like we would on a conventional loan. You're not waiting for the government on any of this stuff. I mean, we don't talk to the SBA. We just input some stuff into a back end system, press a button, it spits out an SBA approval, and we close the loan. So it's not as bad as people think.
Okay, so if I'm an owner and I go, okay, I'm gonna call Ray. I want $3 million, but Ray comes back and says 2.5. And I talked to a few of the banks; they all say 2.5. That's or 2.6, 2.4. It's not three. And I say, well, okay, Ray, how long will it take me? I understand there's different levers that they can pull to make this possible, depending on what the problem is. But like, how much more? How much time needs to elapse before they can come back and say, okay, I've done what you said. I'm looking for 3 million now. Is it like a 3 month process, a 6 month process, a 2 year process? How long does that take?
It's a great question because this could probably be one of the most enlightening parts of this episode. SBA lenders are tax return lenders by their nature. So you get one shot a year to file a tax return that's going to show enough cash flow to so that a buyer can get as much leverage as possible to buy your business. So right now is a perfect time because you probably haven't filed your 2025 tax return. And we probably have to light this page up with like disclaimers about CPA advice and stuff like that right now. But all I'm going to say is that tax return, that 2025 tax return is going to be probably the most key piece of underwriting material that we're going to base the loan off of. And if it's not showing us that there's enough cash flow to support the number you're looking for, then we're going to be looking at for the 2026 tax return in a year from now. And then we're going to reassess.
So make sure I'm clear here. Like you said, this is February 3rd we're recording on. So I'm going to have to get you the 2025 tax return before we close. So in this 60-day window, that's going to be needed to verify what I've provided you already. And then B, if it doesn't hit it, then I would need to go into next year and then get you the 2026 tax return. So if you file an extension, you file like August or September normally, it's not really March or April, it's really next October potentially, because the way that you file your taxes will push the date out further. Is that correct?
Exactly. I mean, today, right now, most of our decisions are being weighed heavily on the 2024 tax return, right? And we may find a deal today and say, hey, this isn't working based on this 2024 tax return, but these 2025 numbers are up. Let's file a tax return and base it off that. So then they're going to rush to do that. If they don't need to, because 2024 works, then we don't need to file the 2025 tax return in this stage in the game. I think towards the middle of the year, we start asking for that. After June 30th, I think we just stand like as a standard practice, try to get all those filed before we close. But no, 2024 works right now. If it doesn't, and 2025 is the magic year, and we're seeing a lot of that where it's like, hey, because you want to sell, you kind of want to, I don't want to say juice up your numbers, but you want to sell on a high. So 2025 probably maybe is better, and you want to base it off that. But hey, guess what? That means you're going to have to file very quickly your tax return because the SBA lender is going to want to make sure those numbers are accurate. And the way they do that is with tax returns and verifying those tax returns with the IRS on the back end, right? So now, if even based on 25, your numbers in your head's too high, then you've got some more work to do in 2026 and then file. And then we're talking about this in 2027.
Okay, and so what about amended returns? You're like, oh, okay, you sit down with your CPA, a tax attorney, not advocating breaking the law here. I'm just saying, like, you sit down and you go, okay, we want to squeeze this lemon a little bit more, make sure we did everything right. Turns out there is that difference in the taxes. We're being kind of reckless. We want to sell. Can we file an amended return and then show that to you and go, oh, okay, now we hit those numbers?
It's a great question because this could go either way, right? We see amended tax returns quite often. When we see that, we get the returns, we get the amendment, we see the differences, and we get a letter of explanation saying, hey, what happened here? The CPA usually missed something was missed, and we amended it. And that explanation has to make sense, right? Because if it's just like, hey, something that's potentially a character flaw or something shady, obviously that's going to just send red flags up and ruin the whole transaction. But if you missed something on your return and you file an amended return, and that makes sense as an explanation, then we will go off the amended return.
Does it help, hurt, matter if it's a tax attorney that does an amended return versus a CPA? Does that weigh on you guys at all?
No, and CPA, we weigh heavily into CPAs. Like, I think anytime a CPA is assisting a borrower, we think that's a great thing. They're licensed, and we feel comfortable with that. I have not seen a tax attorney actually be involved on any of my transactions personally, but I would probably be neutral on that.
That's fine. It's just the key there that you said that I heard was if Ryan goes back and amends Ryan's returns, you're going to look at it with a lot of questions. If I have the CPA or a tax attorney potentially amend it because they are licensed and certified, all that stuff, you're going to go, okay, it might not pass the sniff test. You still might have questions, but you're going to feel more comfortable with that because they have their certain reputation and standards and ethics to uphold.
Yeah, and it happens, and I've seen this many times, and 9 times out of 10, it's a perfectly legitimate reason they miss something. It's an honest mistake. I did happen to me personally before, so I get it. But yeah, so doing it yourself, I would probably not recommend.
Well, and I think that's one of the things, and I'm trying to figure out how to formulate this because it seems that for some owners at least, they've been told, cut, save here, be cheap, but get the free trials, kind of that mentality. But then when you go to sell, you've got to be kind of careful because that can actually cost you a lot more money than it can make you. Because if you're doing your taxes with QuickBooks or TurboTax or whatever it is versus having a CPA, or if your CPA is not really helping you go through your stuff quarterly or monthly or whatever it might be, depending on the size of the company, at the end of the day, it can cost you a lot of money. And so, with this analogy that you're making here, if you wait to the end to file your taxes, and one thing we've talked about on the show before is, you've been hoarding cash because you get paid a cash a lot in your business, and then you go to the SBA like, hey, here's the tax return, but actually, I've got $1 million a year in cash I'm actually collecting. I'm just not reporting that. It's just not going to fly. It's just not going to fly. And so, I think owners hopefully are becoming more educated to realize that the way they've done it and gotten along doing it is going to cost them a lot of money when it comes to sell their business or prevent them from selling at all.
I wish I can say I haven't seen that, because you would think, why would somebody admit to, you know, tax, evasion, I guess, right? But I've seen it. It's obviously what cash businesses, particularly, where it's like, hey, they're showing me this, and the buyer is telling me that the seller told them that there's also this other cash that is not being reported. And I'm just like, okay, great. Obviously we can't use that. It's not being counted in the valuation. It's not being counted in the loan. You're leaving money on the table 100% as a seller when you're doing that.
So I don't know. Do you guys go above the SBA limit? Do y'all have the topper as well, or just do the 5 million?
We just do the 5 million.
Okay, so we'll keep it there then. So I know when you get kind of that, um, you know, 3, 4, 5 million EBITDA range, the valuations can be kind of crazy because of what all is going on. And the SBA, as you mentioned, it is more there's more guidelines. So how much can though an owner improve their valuation year over year? Because you said, okay, well, tax return for 2024, we'll say tax return for 2025. How much can they actually, if they're hearing this, are they talking about 100K? Is it $1 million? Like how much can they actually swing the needle year to year?
I mean, think of it this way. If the average multiple is 4x, for every dollar you're not reporting or, writing off to minimize your tax liability, you're leaving $4 of valuation on the table, right? That's the easiest way to explain it. Now, there's writing off heavily, travel, entertainment, meals. That's kind of the biggest one I see, where they're literally living out of the business. That is stuff that I'm not going to ever use on as an SBA lender, but the the brokers typically will use that in their presentation, bring it to market to say, hey, there's another 50,000 here from these seller discretionary expenses that, are going to be impossible to really track down. You can get a ledger, but like SBA, we'd have to prove it out, and I'm not going to go track down McDonald's receipts for $19 here and, an Uber Eats there. So we just toss that out right away. So right there, you have to make that decision for yourself and with your CPA of like, does it make sense for me to expense and take a more aggressive, posture on expensing all of these different things because, I was at McDonald's, but I was Zoom calling a client and, and so I was working, and should I write that off and stuff versus having totally clean books that don't include all of those really what they are personal expenses. And there's a line that everyone's got to decide, where that line is.
I've got a client right now, and he is super anal about his books. It's great. Like his CPA one time said, you can't write, this is what he told me at least, you can't write off these work boots. And it's like he writes off basically, unless it's a true business expense, nothing. But the books are pristine, right? There's no ifs, ands, or buts about what's going on. And so that's great. And that's helped him because he's worried about certain things. And you talk about the personal expenses there. It's not just the McDonald's. The commingling, if you're not careful, can pierce your corporate veil. And so if you don't sell and you get sued, then all of a sudden your personal assets can be on the line as well. And so like it's that line that you've got to determine, it's not just taxes, it's also risk and liability if you can't sell the business for whatever reason, or you're going to sell in 3 years and you just don't get there. And so there's a tax component, but there's also just the personal liability component for your personal assets that's at risk. And so I don't think that gets talked about enough. People go, oh, the taxes. It's like, well, the corporate veil. I'm not an attorney. Talk to an attorney about piercing the corporate veil, but there is this big risk there from commingling. And so if you push it too far and it gets discovered, your personal assets can be on the line. So it's a big risk.
Well, I have not heard that point made actually. And, ad backs is one of my favorite conversations. We were just talking about it here as a team at True Liant. And because we see a pretty wide range of them, and there's some that are valid, like, technically, yeah. I mean, the buyer, if the seller's writing off expensive 5-star hotel type of vacations and stuff like that, the buyers are maybe they don't live like that and they're not going to do that. And then, it is going to be cash flow. It's just a matter of like, are we really going to document all those different receipts? And the answer is no with us. But then there's also ones that are kind of more interesting, like, I've seen tariffs as presented as an ad back. I've seen recruiter fees. I've seen marketing rebrands. I've seen all, that type of thing. And so that's a little bit more interesting to talk about because you can then make the arguments both ways. I mean, I could tell you on everything I just said, it's no, we're not counting those because while maybe you can make the case here or there, it's for an SBA lender to use it in their cash flow modeling, it's got to be rock solid. So it's got to be something very solid where there's no impact to the P&L. Like it's fully non-recurring. For the buyer's not going to incur this cost. Examples of those are going to be like the seller running their Mercedes through their construction company and the seller paying their daughter who's at UCLA, not involved in the business, and stuff like that you just see that are pretty clear cut and easy to document. Like that's some of the stuff we're gonna look at.
Yeah. So Ray and I are an attorney. So talk to your attorney about the corporate veil. Make sure you're protecting it.
100%.
So we're not saying that.
I can't believe we're putting this on the internet. I mean, this is really, this is why people come here to your channel. I mean, this is just crazy.
Well, thank you for that. But it is something that you need to watch out. And in this case of this owner in particular, his corporate veil, at least from that standpoint, is so tight that insurance is what he needs to protect himself, and he has a real threat. But anyways, so I'll talk to you about debt because I had this happen for a seller. They wanted to sell 1 year, and they got a valuation for $3.1 million. The tariffs hit, made me think of this. And so their sales dipped a little bit. Now they were in the used car space, so they had it was niche used car, really good business. They were netting like $700,000-800,000 a year, really good. But they had a floor plan loan. And so they
Mhm.
had the dip in sales, the tariff messed with prices, and then the valuation from the SBA went from like 3.1 to like 1.7. But turns out the floor plan loan had some of the vehicles that the owner had at his house too. So talk about debt and how that can impact, because owners can get comfortable with what they're doing because they understand the risk. They're very comfortable, but that doesn't mean the buyer or the bank feels as good about it as they do. So how can debt, and the floor plan loan is kind of unique to the cars, but there's other types of debt out there. So how does debt factor into what you guys look at?
100%. I mean, debt is, it's actually a more polarizing topic than you would think. Because if you listen to Dave Ramsey, debt is the devil. And then if you listen to me, debt is literally the American dream. I mean, it's allowing you to buy a business, buy a building, buy that piece of equipment that's going to generate an ROI. And you need debt to do those things. I mean, you're not going to buy these things in cash. And if you want to bet on yourself and not, put it away to make 6 to 8% a year and, be an entrepreneur, like you've got to take on some risk with debt. So I think if it's used responsibly, and that's the big caveat and the key there, it's an amazing tool. And I've seen it used very, very, in a very smart way. The things I would watch out for and avoid are, um, debt that's used for working capital, cash advance types of debt that you're, like, for example, when I get something in the mail all the time, $50,000. I'm a startup entrepreneur. I get 50,000 mailed to me. Hey, you're pre-approved. Sounds nice. 50,000 in the bank tomorrow. It's a trap. Run the other way. And the terms are just so, it's very expensive, for in the most part. I mean, MCA, merchant cash advance, that's the scariest one. I mean, that's just a non-starter, I think, for most businesses. However, it's a huge industry, so people are taking on those debts. SBA, they recently banned our ability to refinance them. We were, as SBA lenders, their only lifeline. And even when we would look at these businesses that had these MCA loans, 9 out of 10 of them were crappy deals, because you're in pretty bad shape to be able to accept a 40, 80% APR type thing. These are daily payments, sometimes weekly payments, but sometimes daily payments. I've seen $100 million company brought to their knees because they took out two of these MCA loans for $400,000. And now the payments are 20 grand, a week or whatever it is. And I said to the guy, I said, why did you do this? $100 million company. His response was, I'm an idiot. And and now it's too late. So you got to be very careful with that.
Okay, I'm gonna give you my contrarian take on Dave Ramsey. Um, he's good for some people. I'm with you, obviously, that you got to have some debt to buy businesses for most people. I honestly think that Dave, in part, either hasn't thought through or doesn't believe what he preaches, because he tells people to do what? Invest their money in the stock market. And those companies almost all use debt. So he's not 100% anti-debt because he says to invest into companies that you use debt. So he's not anti-debt as he says he is.
So I'm in a Twitter feud with Dave Ramsey.
Ask me about that then.
Pub- I publicly uh, asked for his apology.
Oh
And my
wow.
Twitter feud,
Yeah, yeah, yeah,
he's not responded.
yeah.
So it's a feud on
It's a,
my end.
it's a one.
But
You're throwing tomatoes and he's not catching them. I got you.
but listen, I like him. I watch
Mhm.
it and it's entertaining. And um, look, you're not going to go broke by listening to him. But if you want to dream, you have big dreams, then it's you're not gonna get there without taking on a little risk and taking on a little debt, for the most part. I don't want to fully generalize it, but in one of his
Sure.
videos, somebody called in, and long story short is they had an SBA loan that they took out for, I think it was like $1 million, to acquire a business. They had a business that was doing very well. And this was a strategic acquisition. Now, to me, that makes good sense. Cash flowing business, buying another business, similar, it's almost like vertical integration. Now, they had started their business a couple of years before, and so they were fairly new, a couple of years in, right? 2 years in. And business had come down. The buyer was saying it was because of the economy and people's discretionary incomes had tightened. Dave Ramsey basically categorized it like this. He said, so two unemployed people took out $1 million loan. I'm like, Dave, they're not unemployed. They're small business owners. Okay. Making 200 grand a year. They're doing fine. And he's like, we're not in a recession. We're doing just fine. Well, I don't know about that. Cause if you're these kids, I think there was something with a summer camp. So it's like probably parents, like, middle class parents sending their kids at summer camp. Maybe that's a luxury that they could no longer afford because all the interest rates are up. Credit card debt's rising, bank account balances there is something going on. I mean, just because the stock market's pumping, Dave, doesn't mean, discretionary income's not tightening. I'm seeing it firsthand. And so at the end, he said, whoever gave you that SBA loan should be lined up and shot. So I went to Twitter. I said, Dave's calling for the murder of my people, and this is a problem, and I demand an apology.
Yeah. Well, I would, yeah. Again, I'm not pro or anti-Dave. I just think I would love for Dave to answer the question. How does someone invest their money into companies that never take on debt and get the returns that you talk about? And that's not possible to my knowledge. And so if you invest in the S&P 500 or whatever the mutual fund is he's saying this day, those companies are using debt. And so he does believe in debt. And it's just that he doesn't talk about that. And so, and debt's risky, and all the points you made, I'm not saying go, get the loans like you talked about. I agree. So I do appreciate some of the stuff he says, but he does push it too far because those companies have huge lines of credit. Like I used to work in oil and gas, and they would get bank loans to go build pipelines, and then it'd pay back in 3 to 5 years. So Dave's telling you to invest in those companies. So either he doesn't know that, which I know that he does, he's pretty smart, or he doesn't mention that because it doesn't go on brand with his message. And it's that nuance. And I do feel sympathetic for him though, because if I turned on his show today, I could tell you all the answers to the questions, and I haven't listened to his show in probably 10, 15 years. So he does have to just kind of keep pounding home the same thing to his audience. So I am sympathetic to why he can't nuance it, I guess. But he doesn't actually believe no debt because you couldn't invest your money in the stock market if that was the case.
Yeah, I mean, look, debt's a tool, and there's definitely some responsible ways to use it, which has been proven in the market. But at the end of the day, with SBA specifically, the biggest things are it's personally guaranteed, and we got to put a lien on your houses. So if you own a house other than Texas, because of the state laws, SBA lenders got to, generally speaking, put a lien on your house. Okay. That's probably, if there's a deal breaker involved in getting an SBA loan, that's probably the biggest one, whether it's the entrepreneur or their spouse that says you're not putting a lien on my house. But that's the truth of the matter with an SBA loan, is that you are all in, and that's not for everyone. So it is definitely a big commitment you don't want to rush into. But entrepreneurs are wired a certain way where they see the potential, they feel confident in what they're doing, and they're willing to literally bet the house on their vision. And that's what's so inspiring about what I do every day, is because I get to work with those people and every day. And a lot of it's rubbed off on me. I've become very entrepreneurial over the years, whereas that's not how I was raised. I was raised more of a go get a job at the electric company and spend 25 years there. And, that's just not where I ended up, going. I'm inspired by these small business owners.
I love entrepreneurs too, because like today I was talking to a client, and he's like, man, I wish someone would pay me. I'd pay someone $25,000 or $20,000, whatever it was, and I'll give in 5 minutes. They just give me the answer, and I'd go on about my business. So I gave him not all the answers come out of a lawyer, but like, oh, go talk to him about this. This is what you need, da da da. And I said, okay, send me a check for $20K now, and we gotta laugh because he's a client, and he's like, But they have that mentality. Like he just wants the answer to the problem, and it's like he's ready to move forward and get the next thing done. And for him, his business nets 7 figures. So like there's a lot of risk. He's got to get this solved, and he's ready to move forward. And to your point, if you're risking your house when you buy a business, that's a lot of risk, right? That's a lot that you're putting on the line there. And so it is a different mentality. I do appreciate that. So let's wrap it up with this. If I'm an owner, I'm hearing this right now, before I file my taxes, you correct me if I miss anything. The first thing I'm doing is I'm calling my CPA. I'm saying, CPA, how familiar are you with the SBA practices? Because I'm going to sell. I want everything above board. I don't want the SBA to reject this, and I want these books as clean as humanly possible. That's the first thing I'm doing. The second thing I'm doing is I'm calling yourself or someone in the SBA world. I'm saying, hey, what's the value of my business right now? You're gonna give me the valuation. You're gonna say, okay, we can lend, not the valuation, but the loan. We're gonna lend, we can lend 3, 2, whatever it is, $100,000. I don't know, whatever it is, on your business. Great. And if I want to sell, now I know when the buyer comes to send them back to you, and if they're approved, you kind of have understanding of where we're starting at. If you say, well, it's worth, I can lend 3, and I'm like, I want 4, then you could tell me, okay, hey, your tax return next year needs to show this to get to 4. Is that a good summary of kind of what we've talked about and what owners should do?
Yes.
Okay,
Yep.
great. Is there anything
Spot
else I
on.
missed there?
The only other thing I would add is often seller will ask what the buyer needs to look like, because the business is one part of the equation, and it's on an acquisition. It's a good chunk of it. It might be 60% of the equation, right? But what about the other 40%, which is the buyer? What do they need to bring to the table? And I think it's important for sellers to be educated with this, because they may have the answer right in front of their nose, in terms of an employee in the business, a key employee, a partner, a competitor. But ultimately, I'm going to keep it very simple and just tell you that the 3 things I look for in a buyer in order is experience, number 1. Do they have, direct industry experience is ideal, but a lot of the buyers we're seeing come to market don't have direct industry experience. Makes it a little harder, but it's probably at least half of our transactions. It's someone coming from corporate America, coming from tech, coming from the military, coming from wherever, but they're going to be relying on the seller for some of that industry knowledge. But whatever it is, experience is like the number 1 factor. It really is important. Cash, second. Got to have some money to put into the deal, have a little bit of cushion left over, a little rainy day fund. And then credit is the last one. You got to have pretty good personal credit, decent personal credit, 700 plus, that sort of thing. But the cash part, coming back to that, the reason that's interesting is I go back to my former client who's selling their retail business, and he said, I got my manager in here that wants to buy this business. Now, he's going to need some cash. He might be able to get some cash together. SBA lenders are very anal about the cash. Where is it coming from? I want to see it in the bank today. I don't want you to, quote unquote, come up with it. But with a friendly transaction like that, where you've got an employee who's been building your business for you, helping you for 5-10 years plus, and they've got that sweat equity, I'm going to be a lot more lenient with how much cash they're putting into the deal, because when crap hits the fan, most buyers with skin in the game, they're going to stick around and try to figure this out. And if you've been there for 10 years, this is not just something you're going to walk away from. So I believe strongly in that sweat equity, and there's ways to structure these transactions that allow someone who you might not think has the capacity to buy a business actually buy that business. And I've done a lot of those deals with some creative structuring, and I gotta tell you, it's like one of the most rewarding types of transactions I've done. It's one of our favorite types of transaction, and it's one of our easiest ones to get done, even though the buyer may not be the strongest financially, but they know the business the best. And the transition risk, which is where so much of our underwriting is focused, is almost eliminated when it's somebody that already knows the business so well buying the business. So that might be something to think about too.
I'm glad you brought that up because I forgot about that. The internal exit option, especially for this SBA size range, is something that more owners should consider because you probably have a strong number 2 already in place, or you can build that up. If you come to you and say, okay, well, it's worth 3, but right now Tom's not really ready. But you kind of know, okay, now this is the path to get him there and to make sure the deal happens. Can shorten the time as well because of the factors on due diligence and processes that you mentioned earlier. So, okay, well, Ray, where can people find you, connect with you? You are the legendary micro influencer, so they probably already know, but if they don't, where can they go?
Well, I would say go to sbaray.com because I just dropped a really interesting video that I think a lot of people are going to want to know about. And you can also find me at sbaray.com. And you can email me as well at TrueLiant. It's ray.drew@trueliantfcu.org.
Awesome. Well, man, this has been great. Learned a lot as always. I love these conversations, and so thank you so much for your time today.
Thank you. And thanks for having me on. I appreciate it.